The S&P 500 finished the first half of 2024 up 15%, led by large tech companies who continue to benefit from the AI tailwind. The Nasdaq was up nearly 20%, driven by the Magnificent Seven companies. International and emerging markets underperformed the US once again. Bond market returns were just about flat for the year, while small cap stocks finished the first half of the year down about 1%. The rally we've seen over the last 18 months has pushed the forward price-to-earnings ratio of the S&P 500 to about 21 times. This is below the recent peak seen in 2021, but higher than the 25-year average forward price-to-earnings ratio of about 16 times. The outperformance of the top companies in the S&P 500 has led to higher concentration today relative to the past. The top 10 stocks in the index now make up 37% of the index, while the remaining 493 companies make up the balance. Even at the height of the dot-com era, the top 10 companies made up only about 26% of the index. The outperformance of the U.S. equity markets, along with the elevated valuations, reflect investor optimism that the U.S. is on track to achieve a soft landing and avoid a recession. Based on a Wall Street Journal survey of economists, only 29% believe that the U.S. will experience a recession in the next year. This is a stark reversal from the survey a year earlier, when 61% of economists answered that they believed the U.S. would experience a recession. The soft landing story has been supported by a disinflation trend in both headline and core inflation data. Although inflation is still higher than the Federal Reserve's stated 2% target, it has trended lower recently and looks like it may be on track toward achieving that goal. Meanwhile, unemployment remains low at 4%, and job growth has been healthy, with an average of 250,000 jobs per month added since the start of the year. Job openings have retreated from all-time highs of 12 million to pre-pandemic levels of about 8 million. Although the labor market and inflation data indicate that the U.S. is on track to avoid a recession, some of the consumer data is a bit more unclear. Auto and credit card delinquency rates have surged to 15-year highs as lower-income consumers struggle amidst higher prices and higher interest rates. Mortgage delinquency rates remain in line with pre-pandemic levels. Most homeowners locked in 30-year fixed rates at favorable levels. These homeowners are also benefiting from the home price appreciation that the market has seen amidst low inventory levels. Assuming the recent disinflation trend continues, the Fed is predicted to begin cutting its benchmark target rate later this year. The markets are hoping for 2 rate cuts between now and December, although the Fed has forecast 1 rate cut. The Fed is attempting a balancing act. They would like to avoid high rates causing a recession, but they do not want to allow inflation to reignite. Some Fed officials have left the door open to keeping rates high or even increasing rates if inflation moves higher or does not move toward that 2% quickly enough. While we are optimistic that the recent data points indicate that the U.S. is on track to achieve a soft landing, we're closely monitoring consumer and other macro data for signs of either slowing growth or a resurgence in inflation. We maintain an equity portfolio invested broadly across sectors, and we aim to reduce the idiosyncratic risk that market concentration presents.